Every business on earth lives and dies by one thing: cash flow. If you solve it, then you solve everything else. So that might seem overly simplistic, but it's true. If you can solve cash flow for each of your clients, you will have no problem getting and keeping CFO advisory clients. When you think about it, every business that failed did so because they weren't able to generate positive cash flow on a regular basis. Even if a business doesn't turn a profit, so long as they have positive cash flow coming in, the business will continue to exist. Like so many tech startups, it could take years for some businesses to become profitable, but they still have to have positive cash flow coming in, usually in the form of investors that allows them to stay in business. Most small businesses, however, don't have this luxury. So they need someone in their corner that can guide them to solve the cash flow problem for them. So how do you do it? Let's start by breaking down what exactly is cash flow. Cash flow is simply a measurement of the amount of cash a business generates after all of its monthly obligations have been paid. Things like expenses, debt servicing, etc. If a business, let's say, has $10,000 in the bank at the end of last month, and they have $10,001 in the bank at the end of this month, then the business has positive cash flow of $1. Doing this month after month means the business has consistent positive cash flow. And if you could help a business have consistent positive cash flow, then you could solve all of the problems a business has. You've already solved the main one. The reason consistent positive cash flow is so important is that this leftover money is money that a business owner can use to do basically whatever they want with. They can pay themselves or their employees more. They can reinvest it back into their business. They can pay down debt, expand, buy more equipment, really anything. And cash flow is measurable. If you can measure how much it increases or decreases over time, it's the simplest, most direct way to measure both the health of a business and your impact on the business's performance. Now that we understand why cash flow is so important, we need to understand all of the factors that contribute to cash flow. We call these factors drivers because they drive or influence cash flow. And every business everywhere has pretty much the same drivers. And while the drivers may vary in importance depending on the business, they all still contribute to a business's cash flow. Here are the main drivers of cash flow. Now, the first two, of course, are revenue and profit. These drivers are pretty much self-explanatory. But some of the other drivers for cash flow are days sales outstanding and days inventory outstanding. These drivers track the number of days it takes for your clients to get paid by their customers and also the number of days it takes your client to sell through their inventory. Your clients ideally should have both a low days sales outstanding and a low days inventory outstanding. Now, another driver is the sale or purchase of assets. Think of a construction company buying a new truck. Purchasing an asset like a truck decreases cash flow. Selling one increases it. Another driver is days payable outstanding. This measures how long it takes your clients to pay their suppliers. Usually, your clients would like this number to be higher so they can hang on to their cash longer. Another driver of cash flow is using or paying down debt. As I talked about before, your clients probably don't have investors. So many businesses must take on debt. So when your client uses debt, this increases cash flow. And paying down debt, of course, reduces cash flow. This can be a tricky one for your clients and usually requires a good balance and careful planning. Now, another driver is owner investments or distributions. This is just a measurement of any cash your client puts into or takes out of their business. Your client might invest in their business in order to avoid gaining debt so they can purchase, for example, a new truck. Later, once they use that truck to run some new jobs and get a positive ROI from the truck, the owner can then take a distribution from the business to pay themselves back. The investment contributes to positive cash flow and the distribution to the owner to negative cash flow. Okay, when you take all of the drivers I just mentioned and combine them with the drivers of revenue and profit, you could determine which drivers are performing well, which ones are underperforming, and which drivers have the greatest impact for your client's business. Then you could create a plan for your clients to do the one thing needed to stay in business. You'll create a plan to guide them on generating positive cash flow on a regular basis. And once you solve it the first time, you'll just keep solving it again And again, this is how you help your clients get the one thing they really want, which is a growing and successful business. And this is how you become a CFO advisor, and this is how you become irreplaceable. Thanks for watching this video. The team here at the CFO Project has put together some free resources just for accountants, bookkeepers, and tax professionals who are interested in providing a CFO advisory service. Click the link below or go to thecfoproject.com/YouTube. See you in the next video.